On my channel, I often talk about ETFs to invest in. But what about ETFs to avoid? And that's exactly the topic of today's video. Before I proceed with the list of ETFs to avoid, I want to point out one important criterion I used, and that is a given fund must be suitable for risk-conscious, long-term investors. Also, I look at the entire class of ETFs and see if there are better alternatives out there. With that aside, let's delve in. The first set of ETFs to avoid are the older generation of covered call funds, and the ones I'm talking about here are the likes of JEPY, JEPQ, QYLD as well as XYLD. There's a new generation of covered call funds like SPYI, GPIQ and QQI. With these funds, there's very little reason to hold JEPY, JEPQ or QYLD. Why is that? JEPY and JEPQ are not doing very good job of mitigating net asset value erosion risk. The main culprit is their inflexible covered call overlay. Funds like QYLD or JEPQ go heavy on selling call options without a regard for market conditions. For this reason, the upside capture for the older generation of covered call funds is lower. In other words, when Nasdaq 100 or the S&P 500 rallies, funds like JEPY or JEPQ will capture smaller upside. Many investors put their money into JEPY and JEPQ for their above-average yields. But with the risk of NAV erosion being that high for these funds, the distributions don't grow by as much for them compared to some other better alternatives. And that's a big problem, especially in retirement. Stagnating distributions can result in degrading income, especially adjusted for inflation. The new generation of covered call funds from NEOS and Goldman Sachs are much more superior. In my previous videos, I compared some of these funds. For instance, let's look at performance since the April tariff plunge episode. NEOS and Goldman Sachs funds are roughly up, but JEPQ or JEPY stock prices are slower to recover. NEOS and Goldman Sachs take a nuanced approach to their covered call overlay. Thus, my take is that they are superior products for income-focused investors long-term. Here's another set of products that long-term risk-conscious investors should steer clear of, and they are the single-stock covered call funds. The most popular products in this class are by YieldMax. YieldMax popularized single-issuer funds with income overlay. Among them are MSTY, PLTY and TSLY. YieldMax invests in underlying stocks for these funds either directly or via synthetic positions. Then it takes covered call positions for income. YieldMax also uses credit spreads to mitigate NAV erosion for these funds. I don't have anything against these products per se. As any other investment vehicle, they have their purpose, especially under certain circumstances. But as far as their suitability for long-term investors, that's a different matter. Single-issuer ETFs lack their underlying stocks. If someone buys, let's say, PLTY ETF, that means that he's probably bullish on Palantir by design. Then buying Palantir stocks and selling shares for self-distribution is probably a superior approach. PLTY, MSTY and many others don't protect investors from downside, and they cap upside in a big way. That may not sound like a very good deal. Since inception, PLTY lagged PLTR stock by almost twofold. Similar picture is for MSTY, TSLY or APLY. Also, these aggressive covered call funds are not tax efficient in taxable accounts. Let's take PLTY. When Palantir stock rallied in 2024, most of PLTY distributions got taxed as ordinary income in 2024. But what if PLTR stock tanks? Well, that's not a good outcome either way. PLTY would go down and nobody wants their investment to drop. Also, when Palantir stocks drops, all of the PLTY distributions will likely be a return of capital. And return of capital distributions are not bad of themselves. They don't get taxed and reduce your cost basis to zero first. With YieldMax ETFs, it's a matter of 1 or 2 very bad years for the underlying stock for your cost basis to reach zero. After that, all future distributions will get taxed as an ordinary income in taxable accounts. But what if NAV per share declines, which is equivalent to stock price of a fund, as the fund distributes these returns of capital? Well, in that case, the return of capital distributions are not attractive, It's like a fund is giving you your money back. And that's what we observe with many YieldMax ETFs anyways. Things get worse since YieldMax single stock funds use synthetic positions. These synthetic positions have to be rolled over on a regular basis. Most of the time, these synthetic positions expire in less than a year. By rolling them over, YieldMax realizes gains or losses non-stop. By law, most ETFs must distribute at least 90% of their realized income. In the YieldMax case, these distributions get taxed as ordinary income in a taxable account. That's not tax efficient either. The other set of funds that long-term investors should steer clear of are leveraged ETFs. These ETFs promise 2 times or 3 times daily returns based on a certain benchmark. This benchmark can be either a broad-based index like Nasdaq 100 or a single stock like Nvidia. The catch for these funds are in their name. Let's take TQQQ ETF, which gives investors 3 times daily returns for Nasdaq 100. It is true that the daily performance will be almost always close to 3 times, but the long-term performance will never be. In directional markets, the leverage either balloons the fund's assets or reduces them to nothing. Nasdaq 100 may recover after a sharp downturn, but TQQQ may have to scrape the bottom of the barrel for a very long time. If we look at returns for TQQQ ETF since inception, they are indeed massive. The outperformance is staggering. The trick is that TQQQ began trading in 2010, right after the Great Financial Crisis. If TQQQ got its start in, let's say, 2007, this picture would have probably looked very different. Anyway, we may get the impression that TQQQ is a very good deal. But let's zoom in on the 2021-2023 period. As you may know, Nasdaq 100 declined since its 2021 peak by over 30%. If you bought TQQQ sometime in the second half of 2021, your return in 2022 would have been close to negative 70%. And while Nasdaq 100 recovered in 2023, TQQQ languished in the red until 2024. This will be generally true for any quick bear market episode. As the underlying benchmark declines by double digits, the leveraged ETFs will struggle. In fact, if the decline is sequential and quick enough, the loss of capital can be permanent, or it will take years for recovery at best. The left tail of return distributions for leveraged ETFs is fat. In other words, positive returns are frequent. But it takes only one precipitous bear market episode to wipe out all prior gains. Of course, 3x leveraged ETFs are some of the worst, and arguably 2x ETFs may be better. Still, even they carry that risk of wipe out. These funds may have their place for tactical short-term trading, but as far as risk-conscious long-term investors, I would steer clear of them. In my opinion, slow and steady is better than quick riches that can evaporate any day. The fourth class of ETFs that I personally steer clear of as a long-term investor are active ETFs that invest in risky assets, and it's not that hard to spot them. Let's examine one by ARK called ARKK, managed by Kathy Woods and her team. ARKK takes concentrated positions in the high-risk, high-growth stocks. The fund holds sizable allocations in mid, small, and even micro-cap stocks. Yep, those companies with a few hundred millions in market cap. The fund is active. As you may know, many active funds in the US tend to fail to beat their benchmark. For instance, take the S&P 500. Close to 90% of large-cap funds lagged behind the S&P 500 over the last 15 years. I linked a video explaining why this is so. But let's come back to ARKK. With active funds, a lot depends on management, and if managers lose their touch or they leave the firm, then forget it. In fact, as a long-term investor, I try to stay away from active funds as much as I can. With passive index funds, you know exactly what you're getting into. Their selection process is transparent, and most importantly, it is consistent year in and year out. And that's usually not the case with active funds, with very few exceptions, if at all. ARKK is probably an extreme example of an active fund. This ETF makes bold bets on AI, biotechnology and robotic stocks. The problem is that it is easier said than done when it comes to discerning winners from losers. Cathie Wood takes a long-term view on her bets. This has worked sometimes, but sometimes it produces spectacular flops. High conviction can turn into a liability quickly. Take Teladoc Health Company. It's a telemedicine and virtual healthcare company. It used to be very popular among investors at the peak of COVID pandemic. Cathie Wood took a big bet on the stock. At some point in 2021, ARK funds collectively owned over 10% of all Teladoc outstanding stock. But as pandemic recovery ensued, Teladoc growth sputtered. Instead of scaling out, ARK doubled down on Teladoc, the stock continuing declining until losing over 80% of its value by 2024. And that's when Cathie Wood threw in a towel and sold its last Teladoc share at a huge loss. If we compare ARKK to Nasdaq 100, there were periods of outperformance, but underperformance has overwhelmed the fund. This shows how stock picking is so hard to execute on a consistent basis. And my final fund that I wouldn't necessarily stay away from, but really think about whether you want to go all in on it, is the QYLD that tracks the Nasdaq 100. This one probably comes as a surprise for some of my longtime viewers. When I started this channel, I recommended Nasdaq 100 as a way to ride that growth wave. But here's what to keep in mind. If you're looking for a pure play growth exposure, QYLD just happens to be so. The problem is with its design. Nasdaq 100 only includes stocks trading on Nasdaq. Because of only 100 names, QQQ often takes concentrated positions in certain stocks. QYLD did well thanks to high concentration in Magnificent 7 and other growth names. But for an investor interested in growth, there are arguably better constructed funds. Some of them can give a more consistent exposure to growth across the entire US stock market. One fund that I personally invest in is SCHG by Schwab, but there are others, of course. There's nothing wrong with QQQ or QQQM as long as you know about their limitations. They can be terrific vehicles to get that exposure to growth. And that's all I have for ETFs to avoid. Do you have your own fund to avoid? Let me know and drop a comment. If you enjoyed this video, watch my next analysis of why it is so hard to beat the S&P 500. Also like and subscribe for more insights on investing in the future. Thanks for watching, all the best!